Great, great. Are you in Switzerland right now?
I'm in Zurich. We've got one of the first sunny days that we've had for a very long time, which makes me really, really happy. It's been tough here in Zurich because you got these kind of clouds that close in on the valley and they kind of can stay for like a month. And
Yeah.
it's countered by the ability to go up to the ski resorts and ski, which are the closest one is 45 minutes away. The one that I go to is an hour and a half away. But this year it's been mainly cold and dark here in Zurich, which has not been fun. So spring is on its way. And I'm really happy about that.
Yeah, no, that's I think we can all agree that when it's too cold, it's no fun. I'm actually in Connecticut, and it's been a little on or off. And some days it's like just bitterly cold. Today it's like just very gray. I feel like every day is pretty much gray throughout
Yeah.
winter, whether it's hot
What
or cold.
what I would say about Manhattan, at least, or that part of the US, is that if you look at a map of the world, the latitude is about Barcelona. So it's actually further south, closer to the equator than, say, Zurich is, and certainly far closer to the equator than, say, Paris or London. And so the days don't get quite as short. And my experience of New York City is that it's a way brighter winter than, say, in Northern Europe. And Zurich's almost good.
Yeah.
If I'd have moved to Milan, that's south of the mountains, that's a whole different thing again. So
Yeah. Well, Braden mentioned the Harvard connection. I should probably clarify. I did not go to the business school. I was an undergrad over there. But we would run into you guys once in a while at night. Like
and I was
some of the
invited
bars.
to I was invited to give a talk to the undergraduates at one point, sort of a career talk. So I did have just a little bit of contact with the undergraduates. And I did Harvard Summer School one year before I came to the business school, which was really an amazing experience for me. I learned a lot. But I have now done two university tours, and I don't know what the average age of people listening to this is, but I've done two university tours in the Northeast with two of my elder children. I think that's something that's really great to notice and know is that I think that to an American mind, especially somebody who say lives in Connecticut and New York, all is it really is unimportant in my eyes and in so many people's eyes. So long as you're at one of the well-known colleges and universities, you're kind of the same thing. It seems to me, and your opportunities are approximately the same. And I think that having done that university tour, I am less stressed about, for example, where my children go to college or university, as long as it's one of a group of about 30 or 40 or more. So Harvard's
Yeah,
not the
plenty of
be
great
all and end
schools.
all.
That's an entirely different discussion. But yeah, I always joke with my friends like I'm pretty confident I would not have gotten into Harvard today if I, if I had to reapply. It just seems like
But
every year it gets crazier and crazier. The stories I
but
hear.
also, I think that we can also be confident that one can get equally good, if not better, education in other
Oh,
colleges and
100%.
universities. And
Yeah.
my best sense of having a daughter who will be attending Columbia and having a daughter of friends who are attending Harvard is that it's an extremely unusual environment and may not be suited to many of the students who are there actually.
I think it was Thomas Sowell who was talking about that, or like people often just go to a college for the wrong reasons, and it ends up actually kind of backfiring in some ways. But just I guess to set some background, obviously Braden kind of read your quick bio. Um, if you could just, we're going to be talking about a couple individual names, two in India and then Credit Suisse, which is obviously near and dear to you. Uh, what is your background in terms of how you transitioned into value investing and just how you started Aquamarine? Like maybe you can just tell
Yeah.
us the inception, give us the inception story.
Yeah, and the main point to take away from that is that you don't want to do what I did, and that I mean that very, very seriously. And what I did is a huge part of why I wrote the book that I wrote, in that I did made some very, very an enormous career mistake early on. So at the time that I was graduating from business school, but it doesn't matter for the purposes of anybody listening to this, it doesn't matter whether you were graduating from Harvard Business School or from university or from high school even. I was kind of in a rush to get ahead. I wanted to have achieved a lot quickly. I was arrogant and aggressive. And I went to work for an investment bank called D.H. Blair, which at the time, which was pre-internet, when you wanted to look up companies, you had to go to the library and they'd show you past newspapers on microfiche. But there were some reports of this bank having been engaged in unsavory behavior and activity. But I ignored those reports and went to work for it anyway. And I describe it in the first chapter of my book. After I left that bank, the firm was shut down for violations of NASD and other rules. And they were at best, you could say that they were sailing very, very close to the wind. But a more accurate and probably correct interpretation was that they were playing fast and loose with the rules, which basically meant ripping off the client. I think the expression is ripping the client's face off. And I, for some reason, for various reasons, one was that they awarded me the title of vice chairman, well, sorry, not vice chairman, vice president, which was way better than the titles that all my classmates were getting. I thought that that was valuable, and they offered me the opportunity to do deals right away. And but what I had failed to understand, and it's just so super important, is that your reputation is everything. And by associating with bad people, you damage your reputation enormously in a way that when you're young enough is recoverable, but it's long and hard and arduous world to recover. And I just didn't understand that one should never, ever associate with people who have a bad reputation, even if you yourself don't have any wrongdoing yourself, which was the case for me. So I was at an investment bank trying to do venture capital deals, and I thought there must be a better way. And that's when I discovered Warren Buffett and started engrossing myself in everything Warren Buffett. But I also had encountered the self-help genre of literature. So self-help from Anthony Robbins to Dale Carnegie, How to Win Friends and Influence People, Napoleon Hill, Think and Grow Rich. And I needed a way to get out of where I was. And so I started applying many of the ideas in those books to get me to where I wanted to be. And so one of the things that I did was I imagined what Warren Buffett would do in my shoes. And I thought Warren Buffett would not be at this place. So it helped me to leave. It also helped me to start visiting the Berkshire Hathaway meetings. And I started reading the annual reports of companies that Berkshire Hathaway had invested in. I remember I did my very best and eventually found my way to own shares in Ruane Cunniff's mutual fund and started attending the Ruane Cunniff meetings. And so I kind of, through sheer intent and putting one step in front of the other, sort of pulled myself away from this really bad orbit I'd gotten myself into early on. I was applying for jobs at Tweedy Brown. I'd gotten to know Carly Cunniff at Ruane Cunniff. I was going to visit the Peter Cundall conferences in Toronto. I got to know a guy called Tim McIlvaine, who now runs a fund out in Victoria on the west coast of the United States. So I was all over anything that was in any way associated with this view of the world that was espoused by Ben Graham and Warren Buffett. And in my case, I have a family business background, and there was some wealth that my father had built up, and he's looking at me doing this. And I never expected him to entrust me with his savings, but that's effectively what he did, which is the inception of Aquamarine Fund. I think just to go back to the very beginning before I hand the mic back over to you, Divya, is that I could have easily out of Harvard Business School gone and gotten a job at, JP Morgan, Goldman Sachs, McKinsey, one of those well-known brand name firms. And I think that my path would have been far less bumpy had I actually bit my tongue, gotten my ego in check, and accepted I didn't know everything I needed to know, and gone and gotten more experience. And if somebody had said that to me, I'm not sure that I would have listened, but I certainly would have had a better ride.
That's so fascinating, and really interesting to hear how your father kind of entrusted, his accrued wealth to you at, what was a pretty early age. I also think it's interesting that coming from a, say, let's say, call it a fast and loose firm, that you very quickly adopted, the Warren Buffett philosophy around investing, which is obviously long term in nature and sort of the opposite of the get rich quick scheme that I think a lot of folks fall prey to, and actually, like I would argue, causes a lot of much of the roller coaster ups and downs of the market today, where there's just so many people who I think are they're not really investing; they're just kind of day trading, and it creates all kinds of problems. So that's interesting to see. Now you're sitting in Europe. I know you've got investments in India. I'm just curious how did India hit your radar screen, and what was the
Yeah.
first of all, like, what is your mandate? Are you pretty global in terms of what you can invest in? And if so, then sort of how did, just if you can describe to us your screening process, and kind of how you funneled your
Yeah.
way down into India, that'd be really helpful.
And just to, I very much wanted a professional path through life, and I agonized over this offer that my father gave me, and I never sought that out. He kind of observed me and said, "Why don't you do this?" He'd wanted to get me into his business, which he not wanted to, but we both thought it would have been a nice idea, but I would have been in the agricultural chemicals industry, which was not an industry I understood much about. Um, I get a lot of people writing to me who kind of hanker. I don't think that we're better off if we don't ask internally in family type situations for money to manage. And actually, I learned an enormous amount from, I know he's coming on later, from Monish Pabrai about how to approach selling yourself without actually sort of accosting people and making them feel uncomfortable around you. And so there's a way of handling yourself such as the world knows that you're open for business, so to speak, but you're not making them feel uncomfortable at cocktail parties, if you like. So
Completely
my
agree. I mean, it sounds like your father saw your passion for investing, and
right.
he probably agreed with the underlying philosophy himself, and so he felt like you would be a good steward
And I
of
think
the
that
family.
it's very there's been about two or three occasions in my life where I felt so passionate that I want to do something that I've lost sleep over it. And there's this idea that when you have the right passion and you act on it, the world opens up a path for you one way or another, and the resources that you need come to you. And it's some strange combination of dedicating yourself to the idea, being totally um, convinced by the idea, and then taking the steps in front of you. But then other things happen as if by magic, which is kind of interesting. Um, I applied, or I so my approach, and I think it all along has been to protect and grow the wealth that has been entrusted to me. And I think that all sort of mandates that restrict the investor in terms of what asset classes or what geographies or those are kind of like more like marketing tools, if you like, and you have to be open to everything potentially. And I've explained to all sorts of people that if they're entrusting me to manage their money, the real due diligence is on me. It's not is to research who I am, what I've said, do I do what I say I've done in the past, in the future, rather than try and put kind of like limits around me in terms of the geographies that I can invest, for example. So all along, I've had complete freedom in terms of which geographies, which industries, even which instruments. And I've learned as I've gone along. I mean, before we get to India, one of my earlier investments was in the bonds of Eurotunnel. And, I kind of was thinking of Warren Buffett's toll gate and the way if you have a bridge across one road across a particular strait that a lot of traffic needs to move across, that's an amazing business. You can charge them a toll, and that Eurotunnel was kind of a toll. But I invested in bond instruments. So for example, I had a significant investment in bond instruments yielding, say, 20% of the cost that I'd purchased them, which were almost not traded in the market. They were only traded over the counter. So I've invested in unusual instruments. I've invested in unusual countries. Perhaps the listeners might be interested to know that despite having a very, very close ties to Israel for one reason or another, I've not invested in any Israeli businesses, but I have invested in Oman. I've invested in Jordan, and I've even invested in Zimbabwe. And if I think of those investments, none of them made me money. Two of them I exited without having lost much money. I exited all of them without having lost much money. One of them was so small I would not have made much money in any case. But so I think that having a broad mandate of where one can go is kind of daunting and scary for both the manager and his clients, but is also the right way to approach it. And that does not mean that I just jump into having every single investment in sub-Saharan Africa or in frontier markets in Asia. I'm constantly aware that 100% of my family's net worth is invested in the fund. And I ask myself, where would we want to be if the markets were shut and we weren't able to trade or move our positions around? And so I have been asked a lot, because I have investments in China, what proportion of the fund would I want to have invested in China, given that I don't plan to ever live in China, for example. So, but if, as Charlie Munger has said so well, you need to fish where the fish are. And, the fish may not be in your home market. They may not be in the market that you understand the best. And so I think it behooves me to go and look at everything, no matter, and not to have rules that prevent me from looking at things. And I think that it's on that, just to bring it to India, that's the basis on which I started. It wasn't so much that I was looking at India. So in my case, what led me to India was that early on in the life of Acker Marine Fund, I'd had a very, very successful investment in a company called Duff and Phelps, which was a credit rating agency. And Duff and Phelps, I learned through investing in Duff and Phelps that there were different kinds of businesses. Some businesses were better than others. And Divya, I hope you don't mind, because it's just fun to do it. What's so amazing about a rating agency is that despite having very high margins themselves, they actually lower the cost of doing business for their clients. So in many cases, you can't even issue a bond to the markets unless you have a rating from a recognized rating agency. And it's well understood that the cost of the interest rate that a large corporate will pay on their bonds goes down significantly by about 100 basis points if you have a credit rating. And so you're actually saving your clients money in terms of interest costs paid on their debt by having a rating. And so, but it's also a very, very high return on capital business. So that was an amazing ride. And I was very sad to see the company sold. It was sold to Fitch at some point. I wish could have continued on that ride, but that led me on a search for ratings agencies around the world. And for example, in Indonesia, it turned out that there was a private company that was quite interested to sell to us, or at least a share of their company to us. That would have been a bridge too far for me in my kind of like tiny office with a small support staff and not knowing anything about Indonesia. But the situation that arose in India was in an Indian credit rating agency, and hey presto, I could read English and their accounts were in English, which was a real surprise to me, because at the time I just assumed that was the language of the oppressive colonialists, and now all accounts were produced in Hindi or something. But it turned out that I could read their accounts. Now their website wasn't great, but so I went to India not so much because I was looking to invest in India, as because I was looking for credit rating agencies to invest in around the world. And so that kind of reasoning of, this is what's worked in the United States, I wonder if there are any other markets where I might work, has been extremely productive for me. I've found a number of great investment ideas by doing that, but that's a very, very long way of telling you why I ended up in India. And just for your interest, Divya, so I can talk about the process by which I ended up buying shares in Crisil. At that point, I had not met Monish Pabrai. And then when on my first trip to India, I had met him in person once. And I remember writing to him and saying, I'm going to India for the first time. Could you recommend any books for me to read? And he actually gave me a British author then living in India called Dalrymple. I don't remember his first name, City of Jinns. But so that gives a little bit of the history of India, my history with India, if you like.
Yeah. So tell us about the Indian exchange. This is a current position of yours, or is this something?
What drew me to India was Crisil, credit rating agency of India. It's an acronym for something. And I don't own that anymore, much to my great pain and chagrin, because it's been an amazing compounder. I think it's 1,000 bagger at this point, and I had sold it when it was a 5 or a 6 bagger. These are lessons that we learn. But there was some, and I'll just talk a little bit more about that before going to India Energy Exchange. There were some structural issues that made it a particularly attractive investment for somebody like me coming from outside of India. And one of the first questions that anybody ought to ask when investing in any market is, what is the probability that I'll get ripped off? And what is the probability that things that I don't understand about this market are going to bite me in the rear end? And what gave me enormous comfort in the case of CRISIL was that the two largest shareholders one was ICICI Bank, which is extremely well-known, large bank in India, and the other large shareholder was Standard & Poor's. And they were approximately 40% of the shares each, and there was a minority of 20% out there. So my reasoning, which I think was good reasoning, was that you had two big dogs watching each other. And those two big dogs were going to, the small fry, the 20% of the public shareholding, were too small to worry about. And so the probability that one dog would expropriate the other was extremely unlikely. And so I was mice trading amongst the feet of elephants, but there were to sort of move the analogy over to a different animal, there were two large elephants in the room that were watching each other. So that's a past investment. A current investment in the fund is a company called India Energy Exchange. And to give you the history of that, so 20 years ago when I first visited India, companies like CRISIL, you would go to a place called Nariman Point, which is about halfway down the peninsula that is Mumbai. And I was shocked, even at the time, because finance business tends to happen in kind of gleaming glass towers with lots of money around, and that's kind of a feeling of downtown Manhattan, and that's not Nariman Point. And it was still a different atmosphere in India. The atmosphere in India has changed an enormous amount. I still felt the kind of impact of colonial traditions, if you like. A more modern India, you fly to Mumbai and you don't even visit the peninsula. You go to a place called Bandar Kurla Complex, where there are a number of hotels, and it's kind of gleaming glass towers, more what you would expect from a modern financial center, and incredible conferences that are put on by the various brokerage firms. And so I got the chance there to visit, there were hundreds of companies there, and I got to visit with dozens of companies. But the one that stood out for me was India Energy Exchange. One of the things, so many amazing opportunities in India, but there's always the question that arises for somebody like me, hey, you're not Indian, you don't speak Hindi, you didn't grow up there, you have no understanding of local nuances. So what are the ways in which this could bite me in the rear end? And so I've tended to gravitate in India towards businesses that are highly regulated, and over and above that, whose counterparties themselves are highly regulated. And that in and of itself does not protect you. And at the last time I visited, there's some really interesting developments going on in the real estate sector in India, where it is in a certain way far more advanced than the United States and Western Europe. But I still knew that I would have to, if I was buying into an Indian real estate company, I would have to have some evaluation of the management and how honest they are. And that was something that I would have a really hard time doing. By contrast, I felt a lot more confident and comfortable in India Energy Exchange, which is, if you've got an American audience, think of Deutsche Börse, London Stock Exchange, Intercontinental Exchange, those kinds of businesses, which are kind of like the platform that runs the market. And in this case, it's the platform. India Energy Exchange is not the only platform, but it's by far the largest platform that runs India's emerging electricity trading market. And you would say, well, how on earth do you trade electricity? And amazing enough, it does get traded in multiple markets around the world. Here in Europe, we have an exchange called European Energy Exchange, which is owned by Deutsche Börse. And you have an exchange in the north of Europe called Nord Pool, which is owned by the participant companies. And if you imagine that as you move from non-renewable to renewable sources of electricity, electricity supply comes online at intermittent times. It comes online when the sun is shining or when the wind is blowing. And so you need a mechanism by which to match supply and demand and help other suppliers of power to decide whether they're going to supply power into the grid or not. And it turns out, surprise, surprise, that the very most efficient way to do it is to develop a price for power, and that gives a price signal to all market participants. And in order to have a price for power, you need a central clearing, a place where all of the demand and all of the supply is cleared. And if you get to operate an exchange like that, that can be an extremely high return and very, very profitable business, which it is. And it's also happens to be a natural monopoly. So simply understanding that and seeing that India Energy Exchange had solved many of the early problems in setting up an exchange, my next place was to ask myself, what happens if for some reason they get it wrong for a day or two, or there's some kind of abuse of some kind? And I spent a lot of time with former regulators to try and understand how they would rectify when something went wrong. And what I became very clear to me is that the regulators are there to regulate. They're not there to take away licenses. They're there to make sure the system runs. And so I then spent some time looking at existing exchange businesses to understand that even when their legal monopoly is taken away, they have such an incumbent first mover advantage that they continue to do extraordinarily well. So in European and US share trading, exchanges no longer have a monopoly. The New York Stock Exchange doesn't have a monopoly on New York Stock Exchange stocks. Anybody can be an exchange in those stocks. But the New York Stock Exchange has, by setting the rules, by providing information, by setting clearing rules, by having interactions with depositories, they have an enormous incumbent advantage, which is what I also believe is the case with India Energy Exchange. And of course, India needs to produce about at least 3 times per capita the energy it's producing right now. And so it's just an amazing business and amazing way to play the future of India. What I needed to do was be willing to pay up for it. So I did not pay a cheap multiple of earnings. I've been thinking quite a lot about the investment that I made and following Monish Pabrai into Fiat. And in the case of Fiat, we had a company that was trading at a fraction of revenues and at the time had no earnings, but it was easy to see in normal conditions it would maybe be trading at 1 time's earnings. In this case, I did the opposite. I paid up quite a lot. I paid above 30 times earnings for the business. But it's real earnings. It's real cash earnings, cash developing on the balance sheet, unlike many of these bubble stocks where they didn't have any earnings. But I'll stop there to see where you want to go.
Yeah, no, this is really fascinating. The corporate governance element I think is really interesting. You know, talking about how it's not only regulated but having regulated counterparties. I think that's quite an insight. On the valuation, can you just talk about like what the growth looks like, or if you can put that earnings multiple in context a little bit?
Yeah, I mean,
and is
I
it the
don't
kind of
think.
name that you could sit on forever? I mean, I'm just curious what the duration of the investment is.
Yeah, and so I figured out, maybe not that long ago, that I kind of only want to put companies into the portfolio that I want to sit on forever, because it's just too hard to think of a time horizon where effectively you're trying to sell out at a high valuation to other people, which is some kind of pass the parcel game that you want to kind of be in businesses that are, electricity is a great example. Electricity is in demand, is produced. It's funny, it's very hard to store electricity despite all the conversations about batteries. So you have to produce what the system needs at any one time. And for as long as human civilization exists, it will be powered by electricity. So a bit like maybe to use a completely different example, like owning a beer company. For as long as humans, Ben Franklin said that beer is evidence that God loves us and wants us to be happy. As long as humans exist, we're going to be consuming beer. As long as we exist, we're going to be consuming electricity. And therefore, you can imagine that the exchange will be around. So the holding period is forever. I just did a simple calculation of what is a calculation? I mean, it's there for everybody to see. It's not even a calculation. In Europe and in the markets in the United States where there are exchanges, they tend to have a 70 to 80% market penetration. So if you take income, the power generated per capita and multiply by approximately 3 to get it up to developed country standards, and you look at the penetration of the exchanges and say that it's going to be from 10% to 70 or 80%, you got a business that you can easily see will be 20 to 30 times larger. And whether that growth happens this year or next year is not so relevant to me as what the earnings power will be out 10, 15 years when it's, at least 10 times larger, if not 30 times larger. Now, there are many things that could mean that the end point is not quite as large as that. So it may be that so that the company has been restricted in terms of what it can do. It's a shame, but it is what it is, that they've been restricted from trading in derivatives. So they have to trade physical power, derivatives, energy derivatives, which are a really important commodity in developed financial markets, cannot be traded at India Energy Exchange. So that's a whole area of growth that is not available to them. It's also possible that other exchanges, and there are competing exchanges, will develop some kind of dominance in some aspect of energy trading, maybe in different kinds of contracts. So there are multiple different kinds of contracts that are traded. And so that may restrict the ultimate number to, say, half what I'm expecting, or even a third what I'm expecting. But that's still a pretty good number, and it's still a multiple of the size that the business is today. What's interesting right now is that the conditions of last year created there was little to no growth in volumes traded on the exchange for understandable reasons. But in a market like India, where people don't look too far ahead, that needs, people extrapolate last year's experience and say there may be no growth left, and so the company trades at a far lower valuation than it did sort of 18 months beforehand. But I was amazed.
What's the multiple today?
I believe it or not, I don't look at stocks all the time, and I think that in terms of, it's probably still about 40 or 50 times earnings, something like that. But I haven't looked at it recently, and I tend not to look at these companies all the time. I should have really prepared a little bit better for you. But it's a rich multiple of a very, very interesting earnings stream that has not done much over the last year, something like that.
Yeah. How has it fared in, I'm just curious, because we are, at least in the US, there's such a huge macro headwind with rates going up. What have you seen that pressure on Indian stocks due to what's happening here with the central bank, and certainly for a name that you're saying is at 40 times, potentially 50 times. Do you think of that at all as a risk?
I don't think that interest rates came anywhere near as low in India as they did in the United States and Western Europe, and I don't think that they've risen as much. In my case, I kind of don't think of those, what current interest rates are. I kind of think of about a 4% discount rate as being probably the right discount rate to apply over time. They've been. I mean, I don't really look at I don't even look at the index. So I don't really think about it, and I don't try and think of that dynamics, because I don't think it's important for the valuation of the business. I see you looking at your screen. I could do the same thing, but I don't think that it would be appropriate to the listeners. I mean, I really do. In my case, I think of myself as an owner of the business, and I'm not concerned about where the interest rates are too much. And I'm not concerned all that much about even, believe it or not, valuation in terms of current earnings, because I'm looking out. And in a certain way, I realize that that's what a lot of people were doing in some of the meme and non-earning stocks in the United States. Only difference being that this company is actually generating real cash earnings, and it's even repurchasing its shares right now. But I'm looking at it as an asset, and what will the asset look like in 20, 30 years, rather than what it is today.
Yeah. And do you have a similar thesis, with care ratings, it's monopoly of some sort, or
Ca-
a company
ca-
where you can have confidence in 10-year earnings and
So no, I don't, and that's why I don't own nearly as much. And I'm being diffident in buying more of Care Ratings over the last year or two. Just to give you one interesting sort of like thought about India Energy Exchange and Divya, I'm really sharing this because I'm proud to have figured it out, if you like. Is that
yeah.
so what's really interesting for me about an exchange like India Energy Exchange is that you have these long-term contracts between energy producers and the distribution companies, and those are fixed at certain rates. But then you have an energy exchange that comes along, and you've got people supplying all sorts of alternate forms of energy into the exchange, and you get a different price to the long-term contracts that have been established. Almost all the time, the price on the exchange is lower than the bilateral contracts that have been negotiated. So the buyers of electricity are saying, well, why do we need to buy from you, power company, when we can buy from the exchange at a much lower price, which moves volume onto the exchange, except in a year like last year, where energy prices went through the roof and the opposite happened, which took a lot of volume out of the exchange when the prices were higher than on the exchange than the bilateral contracts between the power generators and the distribution companies, setting a very good price signal for power suppliers in terms of what kind of investment to make. But it drove a lot of volume off the exchange. So the business had a lot of headwinds in the last 18 months, and I have no doubt that they'll be reversed. But so you move me on to Care Ratings, which is a really, for me, a really interesting situation where I don't feel anywhere near as confident in the outcome. And I love making the point that I'm about to make, Divya, especially in Indian circles. So uh, the, the leading credit rating agency in India is CRISIL. It's a very powerful, strong brand, and it is now controlled by Standard and Poor's, which is a well-known global firm headquartered in New York. And although it's not a leading rating agency in India, ICRA is another agency that is controlled by Moody's. And so you have some leading brands in India that rate Indian companies and Indian banks that are controlled effectively by Anglo-Saxon institutions, all headquartered in New York City or thereabouts. The largest homegrown agency in India is a company called Care Ratings, which is the one that we're talking about. And it has all the ratings business has all these qualities that are really beautiful, high returns on incremental invested capital and amazing customer economics. But it is a homegrown rating agency in that it doesn't have a foreign participation. And in the last few years, it seems to have spilt ink on its copybook in that it probably allocated too high ratings to some local borrowers that they should not have allocated. And there was a famous case, ILFC, where Care Ratings had allocated an A rating to a company that ultimately went bust. It's a story that we know well. It happened in the United States with agencies like Moody's and Standard and Poor's. But in this case, for example, CRISIL did not allocate an A rating to this company. So they spilt ink on their copybook. And on visiting the company, what I see is a company that has not had the benefit of a foreign owner like Standard Poor's or Standard Poor's or Moody's to teach them what global standards are. But Care has something which is really important, which is it is not owned by colonial foreign powers. And I use that, I'm probably using that word very loosely, but what I see with Care is an enormous amount of low-hanging fruit. This is a company that certainly can grow into being far better processes, far better systems, far better approach to rating businesses. But it's locally owned and controlled. The number one shareholder at Care Ratings is a large Indian pension fund. And the number two owner, which is probably not ideal, but is still okay, is CRISIL, is actually a 10% owner. And so a point that I've not been able to make in person to the regulators, which is the Securities and Exchange Board of India, is that I think it would be a great shame if after having achieved independence from the British and having achieved extraordinarily high growth and lifting so many people out of poverty, and that India would not have global financial institutions that are homegrown. If we fast forward 50 years, India will be the largest English-speaking economy in the world. And I think it would be a shame if all of its rating agencies were controlled out of New York. There should be at least one that is controlled out of India. But long story short, this is a company that has a far more reasonable valuation, is far smaller. There are far more uncertainties as to whether it will develop the way I expect it to develop. But for that, the valuation is lower and the opportunity is great. But I would certainly not, this is very clearly a 5% bet or less, not something I'd be comfortable having far greater proportion of my net worth in.
That's really interesting. What's the, just to frame it, what's the multiple on this name roughly?
Yeah. And again, I don't, it's interesting because I kind of I don't think of multiples, but, and I'm actually just checking it right now to make sure that I don't get it too wrong. But it's about 20 times cash earnings, and I shouldn't really say cash earnings because we should be better than that. But it's actually about 20 times net income as well, and actually, funnily enough, though, Divya, and this is something that I've learned from studying the case of Amazon. If I could control, well, I don't want to control the business, because I'm a foreign shareholder, but I would want the company to invest as much as it possibly can, for example, in employee salaries. I've had conversations with people at the company where I share the example of McKinsey versus a consulting firm in Germany called Roland Berger, where Roland Berger is not as well known as McKinsey, and therefore they pay far higher salaries. Because if you're going to take the risk of going to a less well-known brand, you need to be compensated for it. And one of the most important places for a ratings agency to invest is in its staff, because these staff, when they graduate and go on to become investment bankers, are your most important source of new business. So that's what's very dangerous about looking at kind of things like multiples of earnings. You actually, if I knew that they were spending the money in an intelligent way, I would even be fine with multiple of earnings that was double that if they were spending half of their earnings in, for example, employee salaries.
Are you pretty involved with management for most of the companies you're invested in, or only a few of them, or none of them?
I've not been involved with management, and if somebody reads my book, you will see that I have this statement or this idea in my book that you shouldn't speak to management. I think that that's a really bad idea. If I ever do an update on my book, that's one of the first things that I'll put front and center. But I think that something that I've only realized, Divya, recently is that if you take an antagonistic approach towards management, that word gets around, and very quickly you're not going to be very popular in management circles. So of any company, because they'll find out that that's your nature. By contrast, I think that if I seek to help management achieve their goals, I don't think any management team wakes up in the morning and says, I'm going to rip off the shareholders or I'm going to manage the business badly. None of them really want that. But they are looking for people to help them to get things done. And so I think that I try to amplify the good actions of all the management teams that I follow. And in the expectation and hope that I will constantly be attracted to better and better management teams. This feels like a rabbit hole, but I don't think it will be, but it's easier to describe. Learning from Monish at the back of my annual report, have a page that looks like a company tombstone called Team Aquamarine. And in that, I name all of our suppliers. And even in the case of kind of major accounting and law firms, I name the partners, not the managing partners, but the ones who actually do the work for our firm. And the idea is to recognize the people in my circle. And when they get that recognition, I will attract some of the best people into my circle. So in the case of Care Rating, I've had a couple of conversations with the previous CEO. I've not yet had a conversation with the current CEO, but I've had a very nice exchange with him on LinkedIn of all places. And we're now in WhatsApp exchange. And when I get on the phone with him, it will be more a case of me saying, how can I serve you? how can I help you to achieve what we both want to achieve, rather than starting to try to uh, explain to him that I think I can run the business better. I mean, just to give one example, it may be that the idea of raising employee salaries is a very bad idea that is not clear to me, and I would never presume to understand what is going on inside the business. But I'm sure that Mehul Pandya will understand where I'm coming from and understand the intent, but then a genuine desire to help him. So that might be helping him attend the World Economic Forum, or having his salespeople attend the World Economic Forum so they can acquire new clients, or there are all sorts of ways in which I can be helpful. And that's just a policy of doing that across all the businesses that I'm invested in. And my friend
Yeah.
William Green, the author of Richer, Wiser, Happier, he calls that friendivism, you know?
I like that. I like that term.
Yeah.
Friendivism. I haven't heard that. How concentrated is your portfolio?
Well, it's not an equal weighted portfolio, because my rule of thumb is to invest up to 5% of the then value of the portfolio in any new idea. I'm unlikely to invest more than 5%, because that's just a number that works for me. I've also seen there's a good case to be made for making it 10%, but once I've made the investment, I will allow it to run for a long time. So there are some position sizes that have absolutely ballooned, including BYD, including India Energy Exchange, including Berkshire Hathaway, although over a far longer period. And so there are positions that are of sort of like 15% or more. And there are also positions where I said to myself, I will make this up to 5%, but I never really got past 1%, if you like. And actually, I would tell you that Care Ratings is in that category, along with Alibaba, just to give you two very, very divergent examples. And the reason why Care Ratings is in that category is that I really like the thesis that I've just presented to you. I think it's really interesting, but there's one incontrovertible thing that I can't get away from, which is that ratings businesses around the world are oligopolies, often duopolies between just two businesses, maybe there's space for a third. And in India, there are 5 or 6. And so, I have no doubt that CRISIL is a winner in that oligopoly. They've got a position that is far ahead of everybody else. But whether Care Ratings is a winner is not clear to me. And not long ago, there was an investigatory procedure against a smaller rating agency than Care called Brickworks, where they managed to keep their license, but only just. And so I think that there is, some businesses, it's very, very hard to see why they wouldn't survive pretty much the apocalypse. If you think of Mid-American Energy is a great example of that, or Burlington Northern Railways. This is a business that could easily not survive the apocalypse. And so I want to be extraordinarily careful.
So speaking of hometown companies, hometown heroes, let's talk about Credit Suisse. This, as far as I understand it, is not a position in your fund, but a company you know quite well, has obviously been through a lot, and is going through a pretty serious restructuring. For what it's worth, I actually used to work there. I was an investment banking analyst there for 2 years in New York.
Right.
Right after, so I was there not long after they had acquired DLJ. So it used to be called like CS. Well, it was First Boston, then CS First Boston, then it changed to Credit Suisse Group. But yeah. Any comments on CS in terms of where they stand? Is this like an investable company now? Would love to hear your thoughts.
Yeah, so I feel like a lot of people that I know personally and care about have been very, very badly burned by the, I guess you can call it the bursting of the, whatever it was, the omni bubble that we had in 2000, ending in 2022. And there are both commentators and investors who were extremely convinced, for many, many good reasons, of the qualities of the businesses that they were investing in, which were going to conquer the universe, conquer the planet for sure. And they were buying shares for their portfolio because they were even more enthusiastic about the prospects of the company than the sellers of those shares. and the prospects were extraordinarily good. But my experience has shown, even though it's very hard to do, that we do well as investors when we buy off people who are not enthusiastic. By contrast, we buy off people who are fearful, people who are pessimistic, where the mood is very, very much against the situation. And then if you have the courage to go in there, you can often do extraordinarily well. So just one headline number that is easy for all of us to understand is that the book value, accounting book value of Credit Suisse is approximately 40 billion Swiss francs, and the market cap is approximately 10 or 12 billion Swiss francs. So you have a company that's trading at 1/3 of book. Simple as that. There's a Ben Graham kind of investment, if you like, and obviously it's very, 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 very hated. Having said that, a leveraged financial institution can easily go to zero, and people are sort of focused on the possibility that it could go to zero. So that is the kind of like the downside. I don't think that you can ever get away from the possibility that a financial institution could go to zero or might be forced to raise capital at extremely dilutive rates, the way Credit Suisse has just done. But Credit Suisse has, at this extremely low valuation, now it's acquired over and above Harris Group, which is a well-known shareholder that's reduced their shareholding. It's acquired a shareholding from Saudi Arabia, Sovereign Wealth Fund of Saudi Arabia, and Sovereign Wealth Fund of Qatar, which are now approximately 20% of Credit Suisse. And obviously it has the ability to raise money at the discount window of the Central Bank of Switzerland. And the Central Bank of Switzerland and the Bund, the Swiss sovereign government, have invested very, very significant amounts of money in the previous financial crisis in UBS to the tune of, I believe, 16 billion Swiss francs. So I believe that if they needed a capital raise at this point, between two sovereign wealth funds of some extremely wealthy oil nations with very, very large and deep pockets, and the institutions of the Swiss federal government, that capital would be available. So I don't think there's a shortage of capital to sustain the balance sheet. And there are three clear businesses that the company is restructuring into, which is wealth management, asset management, and it's effectively spinning off the investment banking division in a very complicated series of transactions, but something that makes eminent sense. All of the problems of Credit Suisse arose from its investment banking division, and from the fact that the way the Swiss think and the way New Yorkers think is very, very different. And when you look at the decision making at Greensill, which was the one downfall, and the other one was Archegos, you kind of get a mix of two different cultures that don't really mix very well. But what they're doing is they're sort of hiving the investment bank off into a separately capitalized vehicle with a separate board, very clearly run out of New York by this guy Klein. And so I think it's a sensible restructuring plan, and you're getting the bank at a very, very steep discount to any valuation measure you look at if the business is sustainable. And I think that the business is probably sustainable. So it's a very, very interesting idea, and I keep picking at it, and we'll see where it goes.
Has the problems at the investment bank sort of affected kind of customer traction at the private bank? Have you sort of seen spillover where there might be sort of permanent brand damage that could affect kind of how individuals use the bank itself, the private bank?
And so we are, the fund itself that I run is custodied at Northern Trust at a different bank, but I as an individual and the kind of day-to-day running of my investment business, we use Credit Suisse. And at the time that the first of these crises hit, I went and polled internally. So this is kind of focus group of one. I was a little angry, very angry with the bank for starting its reputation in this way, and asked internally whether this wasn't a reason to move. What was really amazing to me was that at the granular level of day-to-day banking, even in a financial services firm like we are, the considerations are simply do I like my client service rep? Does the IT system work? When I set up wire transfers, when I need to look at my accounts, how easy or how difficult is it? And my impression based on that and a few other conversations is that the franchise is extraordinarily strong. The bank did lose far more assets than I expected it to. I think in terms of wealth management, it's gone from, and I may be, it's down by about 12, 13%, I believe, sort of 600 billion to 500 billion. Although I guess I was going to say, Divya, don't quote me on that, but you don't have to, because here I am revealing, perhaps I don't have those numbers completely under, I would have liked to have double checked them before being asked them, but that's fine. They're rough numbers. So there has been outflows, and that certainly is of concern. But my experience with banking and understanding of banking is that one cannot underestimate the way in which banks are kind of like the plumbing to the power of plumbing was the idea that was expressed to me originally by Monish. If we were to look internally here at moving banks, it would be a project for half a year, and it would entail an enormous amount of work that most people, I think, are extremely reluctant to do. So I think that when we talk about a banking franchise, you really can talk about a banking franchise. And I think that in the case of Switzerland, there are some smaller private banks, but the two largest banks, UBS is well known to have the culture of the Swiss Army, and many people who used to be in the Swiss Army go to UBS. And Credit Suisse has a culture of being far more entrepreneurial and being far more client-oriented. I think there probably is space in terms of a global audience that are interested in Swiss banking for those two kinds of cultures to exist. I would also say that there is certainly, there's no doubt in my mind, there is a precision around Swiss thinking that also comes into banking. And there are many people around the world who want that precision. And that precision hasn't gone away. In fact, it's been enhanced. I don't know either of the two leading characters who are leading this transformation at Credit Suisse, Axel Lehmann and Ulrich Körner, but they are rational, reality-oriented, hard-nosed managers who want to get things right. And so I think that there's plenty of reason for people to want to trust the Credit Suisse that will be in place going forward, in contrast to the Credit Suisse that was, which was still a very, very good place. It's just that there was this disconnect between the investment bank and the way they took decisions and the corporate office in Zurich and the way they took decisions.
And they still have Roger Federer kind of at sporting events repping the name.
Credit, I mean, if you think of brand Switzerland and you're a Roger Federer or other people who are kind of associated with Switzerland, when it comes to financial institutions, there are very few that you can go to. I don't know if Roger Federer is still being employed by Credit Suisse, but I can tell you that the brand Switzerland is an extremely powerful brand, with or without Roger Federer. You've got the White Mountains, but even if you take away visually, I mean, the leading engineering school of Europe is well recognized to be the Federal Polytechnic Institute, or ETH, which is based here in Switzerland. And if you look at Swiss architecture, that architectural school is, so there are qualities in Switzerland that go far beyond Roger Federer that I think behoove Credit Suisse, if you like. Having said that, it's not in the portfolio for similar reasons to why K Ratings is not a huge position, because as somebody wise said, take care of the downside and the upside will take care of itself. And for all of my nice arguments, I cannot rule a downside that is zero for the shareholders. And that might still not be, that doesn't mean that the clients of Credit Suisse don't have safe assets and they continue to do their banking activities, but can you rule out a very dilutive capital raise? No, you can't.
Yeah, very interesting. Guy, we had a question from the audience. Somebody wanted to know, how many investments do you typically put on each year?
Oh, so last year was the most unusual year. I didn't buy one new investment. The only thing I did was sell Twitter. And I was writing my investment. Yeah, I was writing in my investment letter recently with William Green, author of Richer, Wiser, Happier, helps me with the letter. He was up in Foster's and we were holed up in a ski, our sort of ski getaway, writing the letter. And it's like, how do you justify to your investors that you didn't do one portfolio move other than sell one company? I mean, what are they paying you for? And in my case, the answer is they're not paying me. So there isn't a management fee. So I don't feel as bad as about doing it. I think that, but to answer in a more helpful way to the questioner is that I think that it's an 80-20 type sort of distribution, a parallel distribution in terms of how many ideas one looks at in a year. And there'll be some ideas that one discards very quickly. And there are some ideas that one continues to review and mull over for potentially years before one gets to them, or before they ever become a buy for the fund. And so I think that, I mean, if you talk about casting one's eyes over a list of investments, I mean, I run screens where there are hundreds of companies that come out the other side, and I have watch lists where there are anywhere from 20 to 100 companies in those watch lists. And but the rules and the real question is, which are the companies you're reviewing very, very closely, and which are the companies that you're kind of glancing at once a year? And so I would say that, you know, it's a cursory glance at maybe 600 companies, but intensive study on maybe 5 to 10 to 20. And part of the reason for this next to zero turnover last year is that I liked what I had, and I felt like that it was kind of like the right vehicle to carry me through a period of extreme economic uncertainty, if you like. And in general, and there is extreme uncertainty from my perspective, I kind of find the best modus operandi is to do nothing, sit and watch. And that doesn't mean go to cash and sit in a bunker and be scared that the sky is going to fall in our heads. But that also means that I don't have to kind of move the portfolio around enormously, because whatever I buy, I plan to hold it forever, if you like. So I think the one other thing that I would say for the listener that is really kind of interesting for me, and we're starting to work on it internally, is, you know, I'm a scatterbrained Divya. I'm good at thinking about things, but I'm not good at keeping on unless I'm super interested in something. My brain can go all over the place, and to have processes in place which enable me to continue to do in-depth research on particular businesses and bring them up to my mind is both a question of personal knowledge management that I could get into, but also what kind of processes I structure around me within the group of people that I'm working with, which is kind of an interesting question that we're starting to grapple with here. Sorry, you were going to ask a question.
Yeah, there's one other question about sort of country leadership, which gets back to the governance question. You know, Munish is going to be talking about Turkey later today. You know, and I think so. The person who asked the question also mentioned that in the past you've mentioned a hesitation to invest in countries where you've had issues with leadership. You know, be it a prime minister or president, have you? And he brings up an example of some pro golfers not wanting to golf in Saudi Arabia.
Right.
Can you? I'm just curious. I mean, do you think of you know, is sort of, you know, the ruler of a country typically is it a black and white thing, or is it more of a, you know, very much a case by case scenario, or are there countries where you simply just won't invest no matter what the business is?
It's, you know, it's a really interesting question, because I came to that kind of conclusion on Turkey. I certainly came to that kind of conclusion on Russia. I mean, I don't think I could have invested. There are two ideas that, I mean, I think it's being disloyal to the West to do it, but there are people that I know who have investments in Russia. If you're not a citizen of a blacklisted country and you do it in the right way, you can invest in Russia. And two very interesting investments. One is Sberbank, which is the JP Morgan of Russia, that's more than 100 years old and has lasted through the Russian Revolution, World War II, all sorts of things. The other is the Moscow Stock Exchange. I don't think that I want to invest in countries that are at war with the West. For example, I would not do that. You can't do it if you're an American regulated fund anyway. And then the question arises, well, Turkey versus China, and China abuses human rights. The plight of the Uyghurs and other peoples is really questionable. And so why would you not invest in Turkey, which imprisons journalists, and invest in China? And I can't give you any simple, clear answer. I mean, I can go into endless discussions, but it's not a simple, clear answer. Look, 2 years ago, I was aware that Monash was investing in Resus, and it may come up in my letter as a kind of a mistake of omission that I have to analyze, because there is no reason why I could not have put 1% of Aquamarine Fund into Resus after I knew that Monash owned it and after I did my own work on it. And I believe that that is up about 20x for Monash, which is really shows what an extraordinary mind and what an extraordinary investor he is. I had principal reasons for not wanting to invest in Turkey, and it's quite possible that if I'd invested in Turkey, the results would have come out differently. I think that, very briefly, on Russia, which is a human rights abuse, sorry, China, which abuses human rights, and Turkey, which abuses human rights, somehow China's capacity to lift so many people out of poverty somehow diminishes the significance of their abuses of human rights, which all the human rights people that I know would tell me is a terrible, terrible means of reasoning, because it's basically saying, well, if it's expedient, it's right. And one should never engage that kind of reasoning when it comes to human rights. It's, and I can make a case as to why China and Turkey are different. It may just be that I have personal experiences with Turkey that led me to decide not to want to invest there. I had a very successful investment in a Filipino company called Alaska Milk, which had 98% of the condensed milk market, even though many people told me that Imelda Marcos was one of the most corrupt politicians on the planet at the time that she was around, and that the Philippines is a highly corrupt country. The company I invested in was not corrupt. So I can't claim to be more rational than anyone. All I can do is try and observe and explain why I did those decisions, but they may not have been the right ones.
So fascinating. Actually, Guy, just to close, because we're running short on time here, is there any company in America that you're invested in, or have started to circle around?
I'm going to say this at the possible expense of a whole bunch of people looking at it and driving the price up. It'll be a good test to see if anybody pays attention to me or not. I mean, I have investments in Moody's and in Berkshire Hathaway and some businesses that are extremely well known and understood. But so I ran a screen the other day, and I modified the screen slightly, which threw up some really interesting companies. One of which is a brand that I understand really, really well, because my son loves wakeboarding and I've enjoyed growing up water skiing. And those of us who know water skiing know that, probably most of the boats that we want to water ski behind are either brand name Chris-Craft or Mastercraft. But it turns out Mastercraft is a publicly traded company that buys back its own shares and is a powerful brand and is sitting there at a very, very small. I think it's on the borderline between micro cap and small cap, something like that. It's a $500 million valuation. It's a very interesting brand just sitting there. So I'm circling around that and taking a look. But there have been so many companies that I've rejected. And you got to be careful in the United States because it is the world's most picked over market. But there, I've thrown that name out. I wonder what will happen to it.
Guy, that's a great that's a great way to close. It's been an honor, a real privilege, and thank you so much for taking the time. This has been really fascinating, and I think everyone can appreciate your candor. So thanks so much, Guy. We'll be in touch.
Divya, can I just say one thing about Divya to the assembled audience? You may not know, you certainly don't know this, but a few years ago, I contrived a fun exercise for my niece to get to know people in the finance industry in New York, where I emailed a whole bunch of friends and acquaintances in New York and told them that my niece would personally deliver probably some chocolates, some Toblerone chocolates or something. And you should know, Divya, that she was so impressed by meeting you, and she had such a nice time.
Oh, that's so nice of her.
So gracious to do that. And I think that you may have changed her life, actually, because it gave her the confidence that she could go and knock on somebody's door and be personable. And so thank you for doing that. There was an extraordinary act.
Oh, anytime. And if she ever wants to chat again, I'm available.
Well, not too much, but
yeah.
And thank you so much for having me on this. It's a real honor and a privilege. I hope that it adds value to everybody's lives. And